Hi there, I'm Rocky Batani from Private LenderLink. We are at the California Mortgage Association's winter seminar in Newport Beach, California, and I'm joined by Mel Babtkis from Ross Diversified Insurance Services. So Ross Diversified Insurance Services provides insurance to real estate investors and private hard money lenders. So today, Mel's going to talk to us about insurance for investment property loans and all the different things related to that. So thank you for joining us.
Oh, my pleasure, my pleasure. A little bit about us, Ross Diversified Insurance Services. We're a national insurance agency. We've been in business for 32 years, and we've worked with probably about 5,000 different investors and loan servicers and hard money lenders. So we've seen a lot of different cycles in our 30 years, and we kind of know the pitfalls and things to be aware of. And that's what today was going to be all about, is just kind of increase your awareness on some of the things that you should be paying attention to when it comes to insurance.
So let's start from the real estate investor, or in terms of the loan transaction, the borrower. What types of insurance should that party have, or that entity have?
Well, if you're making a loan to a borrower, what you want to make sure of two things is, one, that you have the replacement cost of the structure. All insurance is tied to the structure. The math of 1,000 square feet times $100 a square feet, whatever that math turns out to be, that's your replacement cost. So your loan amount, the value of the property doesn't matter. If you have a $10 million property in Malibu that sits on a beautiful bluff, and you make a $5 million loan on it, but there's that $100,000 shack that's on there, it does no good to insure it for for $5 million. You need to insure it for the replacement cost, because if it burns down, that's all you'll get. So it does no good to insure it for greater than that. The second thing you need to be aware of is the loss payable endorsement. You need to have the lender's loss payable endorsement on the policy. And what this does is it gives you protection, but it also puts you on an island separate from the borrower. For example, if the borrower burns down his own house, his insurance won't cover an arson claim against himself. However, you as the lender stand detached. You still have the same protections you have as the borrower when he's in that house, but if that borrower does damage to the house, you have that protection, and you're paid off in a situation like an arson loan or a vandalism. If, let's say, the owner is you're foreclosing and he wants to take the kitchen sink with him on the way out, well, you have protection for that, again, being separate from the borrower. The borrower has an insurance policy, and then the lender gets listed as that lender's loss payable endorsement on that policy. That doesn't cost the lender anything at all. It should be required of the borrower to furnish that to the lender, and the lender needs to be on that policy. Once he's listed on that lender's loss payable endorsement on the insurance policy of the borrower, again, there should be no cost or fees to the lender for this, then the insurance company is on the hook to notify the lender if that borrower lets his insurance lapse or it's canceled for either non-payment, or maybe he had a series of claims and they're canceling them. Then that lender will get notification that that insurance policy is being canceled. If that happens, the lender will reach out to the borrower. If it's an owner-occupied home, then he's required to send out a couple letters. They're CFPB letters, the Consumer Fraud Protection Bureau letters. It's all part of Dodd-Frank, that basically tells the borrower in a very nice way to get off your duff and furnish us the policy. And if you don't, we're going to force place with a lender's place policy. And we then would force place with the lender's place policy. The lender would do that. If the borrower fails to get a policy and deliver that to the lender, and then that advancement that the lender would have to make for that policy would be added on to the borrower's balance.
But just to clarify again, does the lender have also their own policy separate from the borrower's policy, or
no,
they only take over?
There's no dual insurance. Yeah, if the borrower has the policy and he's got the lender on it, which most typically your borrowers do have, then there's no need for the lender to do other than to track it to make sure that he's listed on as, and again, I'm repeating, the lender's loss payable endorsement.